I think we've got a combined experience of about 150 years on today's panel, so we're not short on insight. So starting on my right, at the end, we have Richard Barwell. Richard is a senior economist at BNP Paribas Asset Management. Before joining BNP in 2015, he was a senior European economist within the Markets International Banking Division of RBS, where he focused on Eurozone and European Central Bank policy. He's also been a UK economist at RBS and was also senior economist at the Bank of England. We have Lawrence Cordogno. He is a visiting professor at the European Institute at the London School of Economics and founder and chief economist of LC Macro Advisors. In a career that spans several decades, Lorenzo has been chief economist to the Italian Treasury, where among other positions, he coordinated the technical preparation of Italy's stability programme and the National Reform Programme. Before the Italian Treasury, he was 11 years at Bank of America in various very senior positions, senior economist, co-head of European economics. We also have Paul Dennis, who is global strategist for BCA Research, one of the world's leading independent global investment research providers. Paul can rightly be categorized as an interest rate veteran. He was trading interest rate futures and options in the pits of the Montreal Exchange in 1988, when many in this room, including me, were in short trousers.
1998.
1998. I wasn't in short trousers in 1998. In 2001, you moved into research, joining BCA until 2006. Then you had some spells as an equity strategist at Lehman's, stroke Nomura International and Credit Suisse in London, before rejoining BCA in 2016. So you've definitely been at the coalface of this recession. Next we have Gabriel Stein at the end here. He's managing director at Rubini Global Economics, where he focuses on developed markets research. Gabriel has also been chief economic advisor to the official Monetary and Financial Institutions Forum and managing director of Stein Brothers, his own economic consultancy. He also helped to set up Lombard Street Research's international economics team, which he led. Gabriel is a graduate of the Stockholm School of Economics, but he's also got a master's degree in military history from the University of Buckingham. In this age of deep geopolitical uncertainty, let's hope he doesn't need to use that degree. And then we have Philip Shaw, who is chief economist at Investec, which he joined in 1997. Before Investec, Philip was chief economist at Union Discount, where he gained particular expertise in interest rate markets and central bank watching. He began his career with the Government Economic Service before joining Barclays as an economist. Last but not least, Dietmar Honung, who is Associate Managing Director at Moody's Investors Service. Dietmar is head of Sovereign Risk Group's European team, covering the European countries and supranationals. Before this, he was Moody's lead analyst on Germany, France, Italy, Ireland, Russia, EU, the European Financial Stability Facility, and the European Stability Mechanism. Busy man. So a lot of experience to draw on there. So welcome to our panel. Thank you very much for joining us. I'm actually going to start with a poll question, which is, if I can find it, where will the next geopolitical shock originate? So if you should on your apps have a poll, you'll be able to find it. It's all very obvious. So please do vote in that. We're going to get the result at the end. So your choices are the US, China, Europe, Middle East, or it just could be anyone. So without further ado, let's kick off. Let's kick off this debate on the end of the world. I will start with Lorenzo. First of all, we had the end of history, Mr. Fukuyama, Dr. Fukuyama. Now we've got the end of history. Are fears about the end of globalization in the light of populism, Trump, Brexit, are these fears exaggerated?
Well, I feel reasonably well, okay, despite all what you said, but I think there are certainly some worrying trends globally. And we all know them. I mean, the so-called secular stagnation. We know the risk to globalization. But at the same time, we have also some positive signs, because I think for quite a long time we haven't seen such a synchronized upswing in the global economy, which is good. Probably it's only cyclical, but still, even though it's cyclical, it is certainly a good phenomenon. And I think it might actually last for a few quarters at least. So it's good news. So at the end of the day, we are not at the end of the world.
Good. Well, at least for a few quarters. Richard, UK perspective, I suppose that's a lot of your background. Is it the end of
The short answer is we just don't know, because questions like these relate to decisions taken by politicians. They're not found in a macro textbook. And I think all of us have learned that our capacity to forecast what will happen at the ballot box is not very strong. It may even be worse than our capacity to forecast GDP. In fact, probably is. I think what we do know is that the people aren't very happy. And that even, a long time ago, when I was not in short trousers, but I had hair on my head, I was a Labour economist. And we knew a decade before the financial crisis that there was a massive increase in inequality. But so long as growth was rising, everyone seemed, macroeconomists were happy about what was going on. So even if we do get a couple of quarters or a couple of years of growth, it's not necessarily clear to me that you will solve those underlying inequalities. And while the people are unhappy, you can get some of these outcomes that a macroeconomist might say is not a good outcome for welfare. It doesn't really matter. You could get another Trump, you can get another Brexit. You could get worse if people are willing to conceive of such a thing. So the short answer is, I don't know. I suspect it'll be hard to unpick a lot of what was done, and it'll be hard to push a lot further forward. But the situation, I think, is very fragile, because on the ground, a lot of people don't feel like they've shared in the benefits of globalization thus far. Even if they may have done, they don't feel like they've done, which is what matters.
Yeah, I mean, Paul, do you agree with that? Do you agree there's this disconnect,
I think answering the question of whether the end of globalization is exaggerated or not, I think to a degree it has been. I think, we're not on this path where we're going to get increasingly stronger globalization. There's not going to be another breakdown of the Soviet Union joining the global trading system. There's not going to be another event like China joining the WTO in 2001. Trump obviously is following through on some of the protectionist threats during the campaign. We're seeing protectionist sentiment in Europe rise up to a lesser degree. But I think there are some globalization bright spots. The China One Road, One Belt initiative, the creation of the Asian Infrastructure Bank by China in 2015. And I don't think we're going back to the intra-war years where you saw protectionism really flare up and a trade war on the back of that. So I think it has been slightly exaggerated.
Okay, all right. So might go, Gabriel, exaggerated? It's all right. You can be optimistic.
Well, the previous era of globalization, which in many ways paralleled the current one, globalization and internet and so on, it ended rather disastrously in 1914. The internet was the telegraph and the telephone in those days, by the way. So we cannot assume that it will not happen. On the other hand, the fact that it ended so disastrously, and the fact that you then had the rise of protectionism in the 1930s, both of those provide us with bad examples of how much worse things could get. So from that perspective, I'm actually reasonably optimistic. And I should say, by the way, I'm much more optimistic than Lorenzo about the future of the world economy. I think the current upswing is going to last much longer than a few quarters. So a hiccup on the path to further globalization, yes. Protectionist rhetoric, very unpleasant, yes. Inequality, less of an issue, I think. So on the whole, I'm still optimistic, but don't discount the dangers. They are there, and all it takes is a few really, really stupid decisions by politicians or by other decision makers.
That's fine, because we've got the DUP over here and Trump in Washington, so there won't be any stupid decisions. We hope.
Not even any stupid tweets.
Or any stupid tweets. Philip, are you an optimist?
I'm relatively optimistic. I think it is an exaggeration to say it's the end of the world or end of globalization, but things could still go badly wrong. If you ask most economists, they'll tell you that globalization and free trade are very good things, but we also know that there are winners and there are those that lose from it or at least win less. And following a period where we've had the great financial crisis and the big recession, austerity, now we've got a productivity issue which is also crimping people's living standards. Globalization is an easy target for populist politicians. And unless policymakers can begin to raise productivity growth and living standards and perhaps inequality as well, then the idea that you can protect your economy by putting up barriers is always going to be a tempting one for politicians to use. So I think we've got some breathing space, but there is a lot of work to be done.
Okay, a lot of work to be done. Dima, a lot of work to be done, or do you feel it has been exaggerated that this is a blip, this has happened before in history? What do you feel?
I mean, what we're seeing is a deceleration of globalization, and that has already kicked in a couple of years ago. So when you look at trade decisions back then, in a way it crystallized really in Trump. I'm cautiously optimistic for the future, because when you look at different economies in the world, I mean, most of them really benefit from globalization. And in a way, the only political leader in the world that stands out in terms of a more my country first policy really is Donald Trump. I mean, what I'm hearing here from the UK, in a way, the vision here is to be outside the EU, but to be a country that participates in globalization, free trade, and even be a competitor to the EU in terms of tax competition and so on. The EU is, by and large, in favor of globalization. China benefits a lot. So I see a significant slowdown. So we see a deceleration here, but the threat from that end, at least for us, is not a credit driver. What we're really concerned about, and what is something that informs our rating architecture at the moment, is that if we compare the world economy's shock absorption capacities to what we had in 2006, we're in a much worse place now. And that goes, I mean, first of all, economic growth by large is lower, the expectations for the future there. Then monetary policy, I mean, there's no powder left here to use in case another shock hits.
Well, we'll move on to that in a minute.
On the fiscal side as well.
So moving on a bit, just what kind of lasting impact are we going to have of these in financial markets of Trump, Brexit, say potential European disharmony, but actually Europe seems to be on an upward trajectory at the moment. Lorenzo?
Well, starting
winners
from
and losers. Should we say winners and losers?
Well, let's say in the U.S., I think, I mean, there are many concerns right now because of the U.S. administration. My concern is more in terms of foreign policy and geopolitics rather than domestic economics, because at the end of the day, I have the feeling that Trump will be kind of, digested by the system and become a kind of mainstream conservative in terms of domestic policies. In terms of foreign policy, where he has full competence on what he is doing, he might actually be quite dangerous, I think, because some unpredictable moves. So
Can you define dangerous?
Dangerous meaning, that there are some areas where you can actually easily have a conflict over the next 2 or 3 years. So I think that is the main concern, because sometimes it's unpredictable where and how this can happen. I think in moving into other areas, I think Asia is still a risky area, but to be quite honest, I think China is now doing okay, is now doing fine economically, and I don't see, at least in the near term, any major risk of unsettling situation or some kind of uncertainty linked to geopolitics or to any economic developments that might actually be there. Europe is has been a big uncertainty, I would say, a few months ago because of a number of electoral events. Now we had the French elections out of the way, which is good. We still have the Italian elections, which are, pending.
could be the next bump.
It could be the next problem, but still, I think overall the economy is doing okay, and Europe is back. Europe is back economically, and I think that is good news.
Europe's that way, UK is sort of going that way.
And unfortunately, yes, because I think...
I'll pass that to Richard, actually. Do you agree with that statement?
I think there is...
Europe that way, UK that way?
No. I think on Europe, I think the market goes through these swings. It's very short-termist. So at the moment, everyone's very happy about Europe. I think people are very complacent. We went from a place it felt like where people thought Le Pen was going to win to populism is dead in Europe. And somehow Brexit has inoculated Europe. To me, it's grossly simplistic and complacent on any number of levels. Just look at what happened in the first round of the presidential elections. It's not clear that 99% of the French people voted for Macron. They simply did not. And we can pretend they did after the event because he won, but that's not the way it was. And in the medium term, everyone knows in this room, or anyone who's thinks about the sovereign bond market in Europe, knows there are very big fundamental questions that lurk in the background, but they're just very hard to trade at this moment. They have not gone away. Well, I was thinking more of big sovereigns with governments with a hell of a lot of debt, with very low trend growth. Interest rates will normalize. And then beyond that, again, to go back to the first question, the real concern remains the politics. And I think Dietmar made a similar point about the fundamental fragility of the system, not just in terms of the capacity of fiscal policy and monetary policy to respond, but how the people will respond if there's another crisis. Because right now it might feel okay, but around the corner there may be politicians who say, why don't we restructure debt? It's someone else's problem. Why don't we nationalise the commanding heights of the economy? Why not?
We're talking Corbyn now, aren't we?
Well, you might be. I was just broadly generalising. But the idea that everything is fine now, or just everything is fine outside the UK, and the UK has a particular problem, I just think is grossly complacent. But that's the way to make money today. It may not be the way to make money next week. I think that's the way markets have been trading. 3-6 months ago, whatever, Trump was the new big thing. Bond markets moved massively. We've almost completely priced them out now. And that may not, again, be a sensible position to be in 3-6 months.
We might discuss that actually later. Gabriel, I was going to say, you made a very interesting comment in our pre-panel chat about Trump and what you felt, about him.
I wanted to make another point, but since you asked, yes, I will say that. I was in Washington earlier this spring and meeting people from the Senate and from the House and so on. And as everyone was trying to figure out if Donald Trump was the best president since sliced bread was invented or the worst ever, one of the views that came up repeatedly was, well, actually, he will in the end turn out to have been pretty insignificant. And sadly, even though I tweeted that in the desperate hope it would reach him and he would then attack me on Twitter, nobody retweeted sufficiently for that to happen. But I wanted to make a point to something that Ronald just said, that Richard just said, which is what happens if the importance of politics, and Lorenzo was saying how now we have the French elections out of the way and that was good and so on. I think what's really interesting here is is France in particular. France is a perennial problem but never an acute problem, and now France has a president who actually has an overwhelming mandate to implement whatever reforms he claims he's going to do, make the labor market more flexible, cut down on the public sector and so on. Although, mind you, he's only talking about cutting public spending to the bare bones, 52% of GDP. I mean, practically doing away with it altogether, in other words. But if he fails to do this, if he succeeds, he has all the power he needs to succeed. He has 350 seats out of 577 in Parliament. He won a convincing presidential victory and so on. But if he now fails, if he does what is so typical of French politicians, which is give in if there are street protests and so on, then there is every reason to worry, because then they will have tried everything. They will have tried socialists, they will have tried Republicans, they have tried populists of the center. Who is left to try?
I'm reading between the lines, I think. Yes, we all know.
So to me, that's the worry. Otherwise, I should say there's always a tendency to feel that what we're doing just now is the most important thing ever, and perhaps it isn't really.
Yeah.
Yeah, I think that there is a danger that we all get lulled into a false sense of security because...
Back to this complacency.
Yeah, the cyclical indicators look good, the structural indicators look less good, if I can put it in economic terms here. You know, I think Macron's been very clever in the sense that if you defeat populist parties, you normally do it by stealing their clothes. And we saw that at the start of the year in the Dutch elections, for example. We've seen Theresa May try to do it, at least. Not that successfully, obviously. But Macron's actually challenged the establishment from the centre. And he does have an electoral mandate to reform. But how many times have we seen presidents try it and fail it? You know, what happens if, you know, the Communist Union, CGT, decides it's going to hold lightning strikes? Will he cave in? And, you know, already we're beginning to see some problems in the coalition with his Modem centrist allies. A couple of ministers have resigned over the last 24 hours because of cash for jobs scandals. And, you know, you do need a structural shift and you do need to move on these reforms pretty quickly until you get that cyclical downturn where everybody starts feeling lousy again and it gives the populists, you know, Front National in particular, another advantage.
Or France Insoumise.
I agree. I mean, it's fundamentally lack of experience, isn't it, in France, but also in other, you know, Trump is not a politician, you know. Is this lack of experience a problem?
I mean, I think a bit of volatility of electoral outcomes is a bit concerning. I mean, even though certainly Macron is potentially credit positive for France, I mean, the fact that the party didn't exist 2 years ago and you know, suddenly he crashed the entire system in France, and we have, I mean, in Germany it's all much more muted, but there again, I mean, you have Angela Merkel on the one hand, you have Martin Schulz on the others. I mean, these are extremely stable personalities in the sense that they don't change at all over time and they don't make mistakes. But still, when Martin Schulz was put at the helm of the Social Democrats, there was big enthusiasm. And he didn't, I mean, as far as I know, he hasn't done any mistake in the meantime. But now the Social Democrats are all the way down again without, I mean, it's just a puzzle how moods change in core European countries. I mean, the big observation clearly is that in a way France is has a big opportunity now. And I mean, from a credit perspective, what we would hope for is that France can deliver on a Macron moment, like the UK had its Thatcher moment, or like Germany had the Agenda 2010. So that's something which has been missing in France, a country which, you know, in the 70s, 80s started really with really low debt to GDP. And since then, it's just creeping up with no pause. So if things are good in France, then debt to GDP stabilizes. The next recession, it goes up again. And the question is if really Macron can
That is
make
the
a
question.
change. And then a general comment on, I think things look much better than at the beginning of the year in terms of continental Europe, and Trump and Brexit are clearly helping for the Europeans, and Merkel seems to move here. But it's also to be noted that the bar for the euro area is much higher than for any other country or union in the world. I mean, the euro area cannot tolerate policy missteps as other big sovereigns can, because, I mean, the US, the UK, I mean, these are all tankers in terms of sovereign creditworthiness. They move very slowly, improve, deteriorated somewhat, but, I mean, the US will never be, there's no cliff for the US. There's no cliff. But for a euro area country like Italy, Spain, France, Germany, there is a cliff. I mean, if there would be a majority for exiting from the euro area, then most likely you would have, I mean, not for Germany, but for the others, a significant depreciation. You would have a default on everything. So the bar for Europe is higher than for other sovereigns.
Okay. I want to come to you, Paul. I mean, I've got another question for you, but have you got any comments on that?
Just quickly, I think, you know, in terms of forecasting the winners and losers out of Trump and Brexit, you have to forecast what Trump is going to do and what Brexit's going to look like. And I think in terms of what Trump's going to do, I think it's very unlikely that we see anything in the way of a meaningful infrastructure spending package, but I think it's very likely that we get tax cuts. I forget who it was that said this, but Republicans were put on earth by God to cut taxes, and they're not going to waste this unique opportunity where they control both houses of Congress and the presidency to get it done. I think the important point, though, is that as the plan currently stands now, both Trump's plan and Paul Ryan, House Republican-led plan, all the tax cuts will go to wealthy households. So this is likely to make this inequality gap in the U.S. that's been growing for the last couple decades even worse. So I think that's going to push the U.S. further along this political process to the left. So I think the policies of Bernie Sanders that we saw in the 2016 election will start looking a lot more mainstream in the next election. So I think that's one of the longer lasting implications.
Which is interesting in comparison to the UK election. And in fact, this inequality everyone's talked about, today there's a Day of Rage march after the Grenfell tragedy. You know, it's all happening. But I want to move now on to this mountain of debt, a mountain of debt in a rising rate environment. And as I've announced you as the interest rate expert, I just want to talk a little bit about, we've had a US rate rise. We don't yet know where that's going to stop. We've had a sort of stagnation in the UK, bit of confusion. I think there was a 5-3 vote in the committee. What's the next step for central banks? I think, UK inflation is 2.9%. What's the next step for the main central banks of the world, and what impact will it have?
Yeah, I think we're going to see more rate rises in the U.S., certainly more than what's priced into interest rate futures markets. I think the Phillips curve has certainly flattened over the last couple decades, but the Phillips curve framework is not entirely broken. In the U.S., we're looking at 4.3% unemployment rate. Fed estimates NAIRU at 4.6%, so we'd expect that wage growth will start to pick up a little more than it has so far, and that's put pressure on inflation, central banks to act. So I think we will see that occur more than the market's forecasting. In terms of what sort of pain that has on the economy, I think it depends on what other central banks are going to be able to do.
Is it ready, I suppose, is the question, especially in the US?
Well, I think, if we're moving closer to a situation where other central banks around the world are in a position where the market can anticipate that we're going to eventually see less stimulative policies, rate hikes down the line, then that'll take some of the pressure off the US dollar from Fed rate hikes. So I think it depends on what's happening around the world, but I think certainly the neutral rate of interest has come down a lot more compared to the last decades.
Okay, well that's the sort of US perspective. I mean, UK perspective on this, Richard?
Across the piece, there's two questions. There's what should they do and what will they do? What should they do? Almost in every case, I think policy should remain loose, even in the US. Certainly in the Eurozone, but in many cases, central banks are pulling back. In some cases, Europe particularly, for political reasons rather than economic reasons. There's a split vote on the MPC, but for my money, for what it's worth, I see the activity data are weakening. I see no evidence of a pickup in domestically generated inflation. In fact, the opposite. If I was on the committee, I'd be thinking more about, will I have to ease more, not raise rates? Mm-hmm. At the end of the day, they're trying to achieve an inflation target over a reasonable horizon. And the UK's problem is we have a price level shock. So import prices are high, but that will pass through.
So our
the question is
9%.
Right, but the question is in the medium, you can't really affect inflation today anyway, so forget about that. As a central bank,
inflation, can't do anything about
you should be thinking about inflation 2-3 years out. You're trying to stabilize the economy and inflation. And unless they lose control of expectations, which I don't think they will, in the medium term, if you think an output gap is widening again, if you think underlying inflation is very, very weak, if you tighten policy now, you'll make the problem worse, not better. I'm not convinced. If we tighten rates here, eventually inflation will go back to 2% and keep falling, and that's not the job. But I'd be much more worried about what's going on in Europe, where I think the ECB is going to taper for basically political reasons, and de facto they've given up, I think, on achieving their target. The language used to be back to target as fast as possible. Now it's all about avoiding deflation. And some of the governing council come out and openly say, we're not sure we can achieve 2%. And that's deeply worrying for Europe.
Lorenzo, I've just appointed you governor of the ECB. What are you going to do tomorrow?
What was just said about the UK, I think is true also in the Eurozone, although the cyclical position is slightly different. But in the UK, it was a one-off shock, Brexit, and basically driving exchange rate, driving maybe prices up, but it's a one-off. So you has As central bank, you should not react to that, okay? You should wait for second round effects and stuff like that. In Europe, there's no such shock, but the economy is gradually recovering, but despite the recovery, there is no sign of inflation. Not even in Germany, that is actually growing above potential right now, okay? But because of the wage negotiation process, wages are unlikely to increase, not even next year, okay? So effectively, despite the economic upswing, there is no sign of inflation going up. So that means that the ECB has plenty of time to adjust rates up. And my guess is that it will be extremely cautious. I think it's telling the market reaction. So financial markets are not always right, okay? They might be wrong, okay?
Heavens above.
But if you look at the market reaction in the past, not just in the Eurozone, but across the world, every time you see signs of central bankers trying to kind of signal or give a small hint about increasing rates or moving towards normalization, financial markets not happy. Actually, long-term rates go down, meaning that probably there is no such a risk on the inflation side.
Okay, I've got a hand up over here. Gabriel, what are your thoughts on that?
Many. I think
Try and keep them brief because we want to get to
I'll
the
do
other
my very
thoughts.
best. I think looking at central banks, there are a couple of things that are really important. First of all, growth in most developed economies is currently above trend. Second, following the Great Recession, markets became central bank dependent. Okay, that was the only game in town. But central banks also became markets dependent. And it's very clear if you look at what they've said, people from the Fed, from the Bank of England and others, they don't like that. They don't like the fact that they've given markets at least a suspensive veto over central bank action. The taper tantrum in 2013 is the worst, but not the only example of this. They want to normalize policy. If they cannot do that when the economy is growing above trend, when can they do it? Particularly bearing in mind that even today, interest rates in real terms remain very, very low by historic standards and negative in most countries. They also want to move away from a situation where markets can dictate to them, the point that Lorenzo just made, that markets can dictate to them what to do. And frankly, I think they're right to do it. It is true that we're not seeing much signs of inflation now, but it is equally true if you look at what's happened to financial conditions in the US and elsewhere, and in China for that matter. Central banks are ostensibly tightening policy, financial conditions indices are easing. I think this is the time to move gently towards normalizing monetary policy. And above all, as said, I think central banks want to do it and will do it. Let me say one final thing on inflation expectations.
Yes.
Frankly, I think they're meaningless. In Japan, for instance, inflation expectations remained firmly grounded for years as the country slid into deflation. I don't think they play a particularly important role, and I don't think they should play an important role either.
Okay, I want to move on the note about normalization. I'm going to have a quick poll question. Another poll question. It's on your apps. It is more philosophical debate now about central bank independence and the conflict between monetary and economic policy. Has QE fundamentally distorted markets? Now, the answers are yes, it merely puts off the inevitable. No, it's reinvigorated flagging markets. I don't agree with QE, but it was unavoidable. So let's just I might swing the debate. Actually, you've not said anything for a while. I'm going to ask you a question. Have the monetarists run out of ammunition?
If you are talking about people who want to use monetary policy actively, not completely, no. As we saw in the UK last August, feeling was, well, a 25 basis point cut from 0.5% won't make any difference. Well, if you look at the confidence levels in the second half of the year and the acceleration in consumer spending, I think I'd like to argue with that. But clearly, you haven't got as much firepower as you have done before. Arguably as well, you've got a little bit more space for fiscal policy. If you look at the improvement, for example, in Eurozone fiscal balances, over the past few years, you've got an average budget deficit of probably around 1.5%, which, by the standards of the financial crisis, is quite an impressive improvement. So, I would say you've got, if you're a policymaker, if you need to, you've probably got more space to use fiscal policy. You've got a little bit of space, depending on where you are, to use monetary policy. I understand why central banks, such as the Fed, want to get rates up and reduce their balance sheet, but they mustn't do it in a way that actually brings about the conditions that would require an easing in policy. In other words, there is a danger of tightening too much and too rapidly, and I'm not sure that they really get that.
Okay. Lorenzo, I know you're itching to talk about this because we discussed it before, but I'm going to quickly ask Dietmar what you think about that, whether you think ammunition is running out. What do we do now?
I mean, clearly monetary policy has run into diminishing returns, and in a way we have the perfect cycle here. So when the global financial crisis hit and the euro area crisis, then government balance sheet were put into the situation, and we had this increase in debt to GDP. And then there was a view that monetary policy is much more precise and much more effective, and then the monetary policy was used. And now last year we felt that monetary policy was not effective anymore, so it's back to the fiscal policy. In terms of the capacity of government balance sheet by large, I guess I'm a bit less optimistic here. I mean, it's true that some countries in Europe have made progress, also in debt to GDP, but as a matter of fact, there's a divergence. The countries that anyway are the stronger ones, like Germany, for instance, are the ones that are decreasing their debt to GDP, whereas others which are on the weaker side anyway, like Italy, for instance, there's no progress. Plus, in Europe, we still have the problem. Maybe there is a bit of an advancement after the parliamentary elections in September in Germany, but the situation is as follows. The countries that would be able to use their government balance sheet to do something are not willing, and those that are willing are not able, and that's the dilemma.
And that's the dynamic. Lorenzo, what do you think about this idea that the monetarists run out of ammunition, we need some sort of fiscal solution?
Well, selectively, yes. I think when there is, space, when there is fiscal space, probably countries should use it. But generally speaking, I think you should continue to basically use the monetary tool for as long as it is necessary. I mean, people complain of side effects. Yeah, they are there, okay, but...
it's just the distortion of markets.
Yeah, but let's face it. I mean, the global economy was in intensive care with the oxygen mask of QE, okay, on, and now we are complaining because there were some kind of side effects. Okay, that's okay. I mean, but
maybe it's like giving an alcoholic
ethanol
for his problem.
No, but let's put it away. I think the monetary policy did its job in kind of preventing a more dramatic collapse in the global economy. Now, probably in Europe, we should complain that the patient has been waiting outside of the intensive care for too long. Okay, and now it's suffering because it came in too late, and that.
Hang on, he's still in there, though. He's still ill.
But that's another issue. But let's put it away. Now, I think it's time to think about the exit strategy. And in the context of the exit strategy, both in Europe and elsewhere, you need to kind of find a way to rebuild financial markets where, some basic relationship has disappeared. I mean, I was there listening in the previous panel, and one guy said, the markets have disappeared in some areas simply because there is the ECB that is replacing market. Now this needs to be rebuilt, okay? You need to rebuild interbank markets. Interbank markets at the short term have disappeared in Europe, and they are still missing, okay? So you need to rebuild these markets and rebuild the financial infrastructure in Europe and probably elsewhere. So there is a lot of job that needs to be done by central bankers in the context of exiting from the ultra-accommodative monetary policy. But it's not an impossible job. Can be done, can be managed. I'm sure that the ECB will have all the tools to do it.
Paul, bloated balance sheets, exit strategies. What's the answer?
Yeah, I think, QE, obviously, there's been some costs associated with it, but I think, I'd put myself in the camp that it was better than not implementing these unorthodox monetary policies, so it was a good decision. I think, whether monetary policymakers are out of bullets, I think there's limited room for rates to come down. You can ramp up QE again, some countries more than others, but to use a North American expression, you're probably in the 7th inning of a 9th inning baseball game on that front. I think the next big thing, once the next major global downturn hits, is that you'll start to need to see monetary policy and fiscal policy working together.
Yeah, yeah. Richard, cricket analogy, just to even the balance? What day of the test match?
I don't play cricket. I exactly agree with the last point. They're not out of ammunition, but all the easy stuff has been done. Certainly the stuff that central bankers can do without feeling like they're treading on the toes of finance ministers. The one last big thing that's there is effectively being done by the Bank of Japan, but they're not being open about it. The last big thing is to say we're going to do QE and it's a permanent monetary expansion. We're never ever going to sell the bonds back. Every time they mature, we'll reinvest. Oh, and by the way, we're doing this to overshoot the inflation target, and we will carry on. Because that's really the last big tool, is the kind, which comes from the academic literature, which is the forward guidance that we will keep rates low, keep policy loose for too long. But again, to the point, I think you do that precisely because you care about, to the earlier discussion, inflation expectations. And at least the way I look at it, they are fundamental to the macro mechanism that we talk about is based on real interest rates. It's based on nominal rates relative to inflation expectations. And if we're not appealing to that as our fundamental device for stabilizing demand, I don't know what we've got. So are we almost out of easy ammunition? Yes. Are there things left to do? Yes. Are they hugely politically contentious? Yes.
Great.
I don't know what the cricket score is for that.
Central banks' monetary policy has plenty of ammunition left.
Plenty of ammo.
For instance, they could have policies that are aimed at boosting money supply, which apart from the Bank of England, none of them really intended to do, because they haven't. But what is worrying, what I would worry about particularly in this context, is that it is likely for a number of reasons, including faster growth, including the slimming of central banks' balance sheet, that we are entering into a secular bond bear market. In other words, a multi-decade bond bear market, and then it behooves investors to think very carefully about how alternative asset classes will do. That, of course, by the way, assumes that central banks remain independent, which is by no means entirely set.
Okay. That seems secular. Do you agree with that, Dietmar? Secular bear bond market?
I mean, as a rating agency, we don't necessarily have forecasts on yields, but when you look at the outlook in terms of much lower growth going forward, there's not that much fantasy on that end.
Okay, Philip, again, agree with that. Secular bear bond market?
Well, I think we've been in a situation over the last 3 or 4 years where we've had so much QE, it's been a case of rising tide lifting all boats. The question is what happens when the Fed begins to remove some of its QE and we get the tapering and the eventual end of QE from the ECB. Because you've potentially got a reduction in that money supply, you may well see the reverse happening, where you begin to see, you have a secular market in bonds, perhaps bear market in bonds, perhaps that extends to equities as well, given valuation levels. And it's not impossible to see a period where you see some sort of correction in all asset markets because of the QE dynamics, particularly if the Fed says it's going to reduce its balance sheet by $600 billion a year.
Yeah, sounds easy. Moving on a little bit, we had this theme, thinking the unthinkable, what if Brexit is contagious? We all agreed before, we don't think it is, but what we did talk about was whether what the EU does next. I mean, this isn't just about keeping the populists away, how they can change the way they do business, but, are we looking at more integration, common bonds, more fiscal integration? Maybe, Lorenzo, what's the next step for the Union minus Britain?
Well, I think that, there are two different stories here. One is the Eurozone, and one is the EU. To me, the EU is dead when there was the agreement between Tusk and Cameron. and that clearly now is no longer there because of the referendum outcome. But that agreement was the end of the EU as we know it, because effectively there was an open recognition that it was no longer an area aiming to ever closer integration, and was no longer an area aiming to achieve a single currency. So I think the EU is dead as we know it.
EU is dead. Long live the...
Well, the Eurozone, I think, there are different views. My personal view is that no monetary union can actually survive for long without full fiscal and political integration. It might happen in
full fiscal and political integration.
It might happen in 30 years' time, but you need to have a roadmap now in order to achieve that. Otherwise, I think sooner or later we're going to end up in another crisis.
We're running out of time. Quickly, just the rest of us. Does anyone violently disagree with that? You know, the EU is dead. Long live...
But can Italy be part of that integrated Eurozone? Will the German voter taxpayer or the Dutch or the Austrian be prepared to take on the responsibility for Italy? Or does Italy have to crash out first?
That has to go to the former Treasury man.
Well, I'm no longer a Treasury official, so okay.
Well, I mean, you can speak freely.
Purely on a personal basis, I think there must be a way to achieve a compromise. We are talking about, the stock of debt, effectively, and how to spread the stock of debt over the future. And I think there have been a solution put on the table, possible solution put on the table how to deal with that. And I think there needs to be a solution.
Okay. Listen, we are running out of time. I'm sorry, we haven't come near what we wanted to discuss, which is obvious on a panel like this. Questions from the audience. We've got time for a few questions. There's a hand going up there. Could you say your name and who it's directed to, please, or it could be the whole panel?
Yes, my name is Alexander Ustreich. We have an eminent panel here discussing macroeconomics. I like the analogy with patient being in intensive care with oxygen mask. Now the patient is out. We take a little further that analogy. Did we, with best intentions, of course, put some poison in patient blood, which might affect very negatively in the longer term? What I mean, put aside the analogy, sovereign debts grown significantly over the last 10 years or so and keep growing. Mathematically, you'll probably agree, it's almost hard to envisage that the ratio of debt to GDP in some countries, I'm not even talking about Italy or Greece, put them aside, and let's put aside also some very few which have healthy, like Germany, maybe Netherlands, etc. Let's take USA, let's take Britain, maybe France, etc. Something in between, let's call it, okay? With very slow GDP growth and interest on debt accumulating and adding even supposedly great achievement, only 1.5% at every year, mathematically it's going to go up and up. What does the panel think? What is the end game? How is it likely to resolve, if at all?
The whole panel, end game, we've got a hand up.
Yeah, I think that's really illuminating to think in terms of an acute crisis and a structural crisis. And particularly in Europe, we're way past the imminent acute crisis, and 2017 is not the year of an acute imminent crisis, but the structural issues have not been resolved. There's a bit of progress in some countries, but by large it's not. And if you look at our rating constellation in Europe, that's precisely what's reflected there. So we had quite a migration at the time of the euro area debt crisis, but the rebound of ratings has been, in a way, disappointing. I mean, there's Ireland, there's a bit in Portugal, but by large, Italy's rating is at the same level as at the peak of the euro area debt crisis. Spain is still there. So I agree the fundamental issues are there, and it goes back to what I said earlier on the shock absorption capacity, which has diminished and which will be an issue for the future.
Yeah, I mean, precisely on that point, I mean, any good news story about some of these highly indebted sovereigns in the Eurozone is based around good luck and good policy. So the good luck is there's never another recession, there's never another financial crisis, and the never another recession assumption is really problematic when monetary and fiscal policy is stretched. And the good policy assumption relies on the political class understanding year after year, decade after decade, they have to run surpluses and pay down debt. And that goes back to the earlier points, where that political will is just no longer there in most countries. And that's why I think it's so worrying. I think you have to really be an optimist to think everything's going to go great year after year after year after year to get out of this, on the economic front and the political front. And that may happen, or the Germans just come along and pay for everything. And that seems...
That would be something. Well, I said earlier, I believe that we're entering into a secular bond bear market. There is, of course, a potential antidote which will deal with this issue raised as well, and that's financial repression. Central banks lose their independence, governments make sure to goose up inflation. That deals with the debt problem. In other words, you're all defrauded. I don't think that's a good idea, but it is a possibility. There's no question about it.
I think on the arithmetic, I'd be relatively optimistic. You can get the debts to GDP ratios down over the next 3 to 4 years. The problem is, though, that you're doing it from a level between 80 to 100% for a lot of Eurozone countries, and not 40 to 60%. And it's around the 90 to 100% levels where your debt dynamics become very, very difficult. So you are much more vulnerable to a downturn if governments really don't make substantial progress on getting that overhanging debt down.
I think your point sort of, can debt ever sort of solve a debt crisis is a great question. I think the answer to that is yes, in the sense that if the governments, for example, are issuing more debt to do more fiscal stimulus at a time when the private sector is retrenching, and that prevents a deflation from setting in, a deflationary mindset from setting in a time in a crisis, that is a good decision. In terms of the end game, where this is going, with debt levels increasingly going up and up and up, I think it's sort of to my previous point that we're eventually going to have to see monetary and fiscal policymakers work together.
Okay, great. Well, we have run out of time. We don't have time for any more, but thank you very, very much to our panel who've been absolutely wonderful. Some great opinions and insight there. The end of the world as we know it, well, possibly, I think, more the end of understanding and comprehension of what's going on. But thank you again, guys. Thank you to the audience for staying for the last panel. I'll give them a round of applause. And thank you for coming to the conference. Thanks, guys.